Play out, and I'll be right with everybody. Hey everybody, welcome back to the show. Another day in paradise. I gotta tell you, I was a bit surprised today to see that we have Trump come out talking about how we're not going to let institutions buy real estate anymore because homes are to be lived in, not to make money off of, which I thought was a strange statement. So we're going to cover a little bit of that. I just got wind that Netflix has officially won, and Paramount has rejected the Warner Brothers offer backed by, I think it was Ellison. And now we have markets at all-time highs. Talk about an interesting day. And for those of you who ask, okay, Chris, is any of this going to be covered in the podcast? Yeah, it's all going to be covered in the podcast. We're going to be recording that podcast tonight on that show, which will come out next Tuesday. Venezuela, housing, rent control, a bunch of stuff we're going to cover kind of high level here, but we'll break it down more with Saeed on the show a little bit later this evening and then broadcast to you on Tuesday next week. I have made some improvements. You will see that in some of the overlays to make it look a little bit more broadcast worthy and a little bit less, streamer-ish, if you will. That being said, I have also changed the audio equipment. So hopefully, if you guys are hearing this, it doesn't sound terrible, but if at any point in time it sounds absolutely trash, let me know and I will do my best to adjust it. I've tried to keep everything sounding about what you're used to, at least, especially for the audio podcasts and on the platforms that stream. We're using the same equipment here in that room. It'll be a little bit less echo, obviously, and a little bit more conducive because that's really, truly a sound-treated room. But it should sound like me. If it doesn't, then, I'm paranoid and I've been doing this for too long. So let's get into the top headline stuff. I'm going to drag you over and switch screens here, but I wanted to be a little bit more, so kind of finding a rhythm here. I'm trying to be a little bit more research driven on the show. I also have the audio on the podcast working again, so that's cool. I'll be able to play anything we find on social media, anything we find anywhere else. So let's do that real quickly here. Let's get things a little set up on my end. But Trump makes comments. We're gonna search for this real quick because this just came out about institutional housing buyers. So yeah, there you go. Trump says U.S. to ban large investors from buying homes. This was fascinating, and I got a lot to say here. Let's go to Reuters. This is from 1 hour ago. I'm going to pull this up here on the screen for you here. Let's go with the host plus screen view. And for those of you watching the show, you'll also notice that this view here no longer has the bars in between it. I'm a little bit wider, it's a little better framed, but this will also allow me to do this. And I will, again, work actively on putting all this stuff into the show notes that you'll see a little later on channels like YouTube. So if you're watching this and any of the links that come up are interesting to you, just let me know, and we'll put them in the show notes. We should have them all there, but in the event that I don't, just shoot me an email, media@higherstandard.com. And I'd be remiss if I did not say that our sponsor has officially signed up. We are sponsored by Fridays. You can go to joinfridays.com, enter in the code HIGHER, HIGHER, like the higher standard, and you will get a lovely discount, and we'll get some recognition. No pressure, but we love you, so I think it'll be a good combination. And if you guys have been following the show for any length of time, you know that I am also on GLP-1s. I microdose, which they offer. So there you go. Okay, this U.S. will ban Wall Street investors from buying single-family homes, Trump says. Right out the gate, the question is that legal? Is it constitutional? I'm sure the SEC, HUD, a lot of different agencies are going to have comments about that. This is kind of one of those things that probably should go through the general, normal congressional process, not necessarily presidential edict, but we'll see more about that as time goes by. But for now, let's see what the headlines say. And again, I read a little bit of this earlier, so I do have a little bit of a head start on you. U.S. President Donald Trump on Wednesday said his administration is moving to ban Wall Street investors from buying single-family homes in a bid to reduce home prices, a potential blow to private equity landlords. So, yeah, let's just get this done with right out the gate. There's a lot of people who swing one way or the other on the housing issue, okay? Some people believe that institutional money managers and institutional people like private equity companies, Blackstone probably being the most notable one, have driven up home prices. And I get that. I do understand how that simple concept resonates with people. If housing is really supply and demand, and a lot of supply is being bought up by these private institutional companies, these large companies, and the consumer isn't able to buy. And of course, you look at the macro zeitgeist and you say homes are near their highest value of all time. Unaffordability is arguably at the worst it's ever been. This has to be real, right? That's part of the problem. Honestly, it's not. To date, and I know this is going to upset a lot of people, to date, I have not seen a single shred of material evidence other than social media rhetoric which suggests that that is actually causing home prices to go up. Sure, is it taking an incremental amount of supply off the markets? Yeah. Is it a meaningful number? No, I would say at most 3 to 5% of the total stock of housing is being purchased by institutional money buyers on the market. I think multifamily apartment purchasers are probably a little bit more at risk because you got companies like Blackstone who are buying all the mortgages, but I don't necessarily think that's bad either. So there's a whole smorgasbord, if you will, of underlying assumptions by people that don't seem to be rooted in fact. And there's a lot of fodder on places like X, which we are going to go on to here in a little bit, that seems to be giving people, I guess, this consternation, but again, not seemingly invalidated by the data. So going on, in a post on Truth Social, Trump said he was taking immediate action and would ask Congress to codify the measure, adding that he would also be discussing additional housing and affordability proposals in his speech at the Davos World Economic Forum. For those of you who do not know about Davos, it's in Switzerland, and every big major heavy hitter in finance is there. Sorry to say I will not be there. I know, shocker, right? But this is where you see a lot of this kind of, I would say, virtue signaling from the finance community, if that's a thing. You'll see that there. You'll get all the big heavy hitters out there talking. There's been a lot of conversations historically about things like affordability and housing, and every country kind of wants to peacock. There's a lot of private jets that roll in, and a lot of money being spent, and a lot of really high-end watches in the area. But everybody's virtue signaling about how they're going to make the world a better place. It's kind of like it's like CES for electronics, but for the finance community. So for a long time, buying and owning a home was considered the pinnacle of the American dream, Trump wrote, going on to add that inflation had put the dream out of reach for most Americans. Inflation. I don't know that institutional buyers have meaningfully moved that needle. I would say that statement is correct. People live in homes, not corporations, Trump said. Yeah, but that's also being a little kind of tongue-in-cheek, Will, with the information here. So yes, people live in home, not corporations, but corporations rent those homes to make money. So there is a rental market. And for those of you who are in the camp of it's cheaper to rent than it is to buy right now, which is actually true, then they are providing affordable housing vis-a-vis rents, because rents are going to cost you less. Now, you could say that's bringing rental prices up, and in some areas that might be true. You could argue a lot of different use cases there. I'm just saying that statement in and of itself is somewhat misleading. Yes, people live in homes, not corporations, but corporations buy homes to rent, not just to leave on the market and make money with equity upside, because they're making money on the rent cash flow and the equity upside over time. To his point, yes, the owning a home was the American dream. Life, liberty, pursuit of happiness, that literally meant home ownership, right? And to his point again, the single largest contributor to net worths of most Americans throughout the course of history has been their equity appreciation of homes over time. So if you remove the ability to buy homes, because homes are at or the most unaffordable they've ever been in history, you present a problem with where do people move their money. Now, the beauty in this in the last several years, and a lot of people don't want to hear this, that the stock market has outperformed housing in appreciation, even though we've had some spectacular years in housing. You got 14 years of artificial interest rate deflation, and housing prices kind of ran up pretty high. But if you invested in the QQQ or the Mag 7 or any of those stocks, you got a much greater return on your stock ownership than you would have gotten in your home equity over time. The problem is most Americans need the utility of living in their home, so they buy a home. Most Americans don't need the stock market benefits, so what happens? They don't buy the stock. The money sits in cash. They try to save. Well, saving is kind of an outdated methodology. If your money is not going to work for you, for most Americans, you don't get the benefit of passive increases in your home value and equity over time because you didn't buy one. So there's a lot here to unpack. There's also a whole rent control piece of this, which we can get into here. Wall Street institutions, including Blackstone. Remember I mentioned Blackstone earlier? Well, let's go back to this screen here. It's right there if you're watching on the streams and you can read it. If not, I'll put that into the show notes. Blackstone is not as demonized of a company as they tend to get with a social narrative and social rhetoric, and I can answer that in a little more clarity and give some more details here. Wall Street institutions, including Blackstone, have bought up thousands of single-family homes since the financial crisis of 2008 led to a wave of home foreclosures. The trend has attracted criticism from housing advocacy groups and lawmakers, including Democrats, who claim institutional landlords have stoked rent inflation. I'm sorry. Homebuilders shares dropped sharply in the wake of Trump's comments. American Homes for Rent, AMH.N, dropped to a near 3-year low of $28.84 and was halted for volatility. That happens in the markets. If you see too much loss in value or too much increase in value, generally it's always loss. They'll halt your shares for trading for a period of time and then reopen you to the market. And if it happens, I think 3 times, I think they shut you down for the day and then you can retrade later on. Doesn't happen a whole lot to publicly spoken about stocks, but surely that's a thing. Its shares were last down nearly 6% at $30.56. So let's talk about something that's not really getting a lot of media coverage, okay? And this is real, and I don't like talking about politics on the show, but I think there's an element here which is important. Davos is coming up. Actually, let's find out when Davos is real quick. I think that's probably an important differentiation that we should probably talk about. When is Davos 2026? I want to say it's like a month or two. January 19th, 19th through 23rd, 2026. So it's coming up here in about 2 weeks, just under that, about 12 days. So that's kind of meaningful. So here's what's going to happen. All right, let's just make sure we're all on the same page here. The president is deeply concerned about housing, as he should be. We all, as consumers, are deeply concerned about housing. And if we have all this symbolism of bubbles in the economy, you got to hedge your bets. So you're doing the oil thing, you're doing the stock market thing. Stock market's at all-time highs today. We'll get into that in a little bit later. So you've got some pretty interesting things happening. You got to protect home base, and home base for most Americans is housing. So this is an important and relevant topic. But our president, who owns a lot of real estate in and of itself, well, vis-a-vis his entities now, not directly, and his campaign was largely supported by the home builders. So you can rest assured there's going to be conversations between the home builders and the president before he gets to Davos in this World Economic Forum where he makes some big statements. Now, whether that they're going to be supported or not by him, that's a different conversation, and who knows. So let's take a look at where the home builders are right now. While I'm doing this, I'm going to pull this over here so we can multitask a little bit. Blackstone BX.N shares hit a 1 month low of $147.52 and were last down about 5% to 154.49. The PHLX housing index was down 2.1% on the session, on track for its biggest daily percentage drop since November 17th. This should probably be obvious to most of you, but I'm going to ask the question. I'm going to make the statement anyway. And this is a pretty obvious one, but if people are going to be prevented from buying, right? That means in large part that they think that there's going to be more housing stock and less sells, right? And if there's going to be more housing stock and less sells, all right, okay, come on, internet, work for daddy. There we go. All right. If there's going to be these things happening, they think that there's going to be less volume in sales, and the price volatility will show price pressure downward. Price pressure downward, that's not good. And Blackstone, because they make money on buying and renting properties, in small part, this is the rhetoric that you're seeing. You're seeing them trade down. I don't think this is going to be impactful to someone like Blackstone, at least unless something happens, in which case we haven't seen that yet happen. And I think I have Blackstone on the tickers here, but I'm going to hit, there we go. Let's see, Blackstone BX. They're down here we go. They are down currently to 155.50, $7.16, 4.40% on the day. So that's actually one of the tickers you're going to see down here in the ticker bar. So we'll watch that in real time on our ticker here from the THS side of things as this continues to move and change throughout the rest of the day. I'm not sure, again, that this is a super indicative thing for the markets, but we'll see how it goes. At this particular juncture, I don't know. You know, it's kind of one of those. We're in one of those spaces right now where a lot of times this particular presidency will say a lot of things that are fodder for public attention, but not necessarily what I would call likely to happen. So because of that, we're going to see what the market does and what he actually says over time. But for right now, I'm not seeing a whole lot. Let me get my chart back up here. There we go. A whole lot to tell me that this is going to be anything besides media fodder near term. Blackstone did not immediately respond to a request for comment. Why would they? They're going to talk to the president, their higher ups are, and then they're going to go from there. Let's go to the chat here for a little bit. Anybody on Instagram? Let's switch here to the desk view. Anybody on Instagram? Anybody on the other streaming platforms have anything they want to ask or talk about as it relates to this particular housing? I'm going to finish reading this here a little bit, but if you got any comments or anything you want to talk about in particular, let me know. We're going to cover as much of this as we can. It was not immediately clear what legal authority Trump would draw upon to impose such ban on the private market purchases of houses. Trump did not detail the policy, the form it would take, or the legal changes he was seeking from Congress. That is an important statement, okay? Because I kind of let off in the beginning with this, that there is no clear path for him to unilaterally do this, and certainly not without congressional authority. So that there's a whole question mark there. Not to say that it would be the first time the president tried to do something a little more aggressive, but certainly something of value and of interest here. The White House did not, of course, immediately respond to comments, and the Republican president is under growing pressure to address voter anxiety over the cost of living ahead of the midterm elections that will determine whether Trump's Republicans retain control of Congress. So there you go. There's a time-relevant reason to do this on what is likely to be the largest world stage. So that's a pretty palpable reason to do it. So let's dive into a little bit more of some of the commentary that we're seeing around this on the social channels. I'm going to pop into X real quick and see what X and social media is telling us today. All right, so let's go to the social view here. You will also notice this has been slightly revised as well to give you a little bit more bandwidth, a little more view here. On X, Kobeissi letter, Blackstone stock BX falls as much as 9% as President Trump says he's taking immediate steps to ban institutional purchases of single-family homes. Lance Lambert covering this as well. Trump, I am immediately taking steps to ban large institutional investors from buying more single-family homes. He shows a tweet from Truth Social here. Again, Kobeissi letter, breaking news, showing the original one. So this is top of the headline mix here. This is interesting. So 47 million rental units in the U.S., of which 14 million are single-family rentals. If you define institutional as owning 1,000 homes or more, they are 3.4% of the 14 million. If your threshold for institutional is 100 plus homes, it's about 7.2% ownership of all single-family rentals. And that goes to show you exactly what I was talking about at the top of the show when I said it's somewhere between 3 to 5%, and that comes down to the definition of what you think institutional homes are. In the chat, Vic, generally speaking, let's see what you got here. Generally speaking, what would the consequences be of Trump's new proposals for banning institutional investors in home ownership and real estate? Well, to you, the consumer, nothing. I think it would be part of a broader plan to improve affordability, but I don't know that it would impact the consumer at all. As a matter of fact, I think it would do quite the opposite. It would be somewhat of a non-event. Robbie here. What's up, Robbie? Know a realtor who said a client got their offer accepted significantly lower than list, lucky, or shift in the market? I think it's a shift in the market. It really depends. Again, real estate is very subject to the markets that you're in. And because of those proximities to local regional impacts, it's very different. The coast, California, is seeing a bit of an influx, unlike we saw during the pandemic period years, where you're seeing an influx of population growth now back in California. So some of the major coastal regions are showing values go up. You're still seeing, and San Francisco actually in particular, seeing that go up. We covered that in the last live. In the previous conversations that we saw with housing, we also saw that the Austin markets are truly coming down. You've got parts of Texas that are significantly impacted. So I think there's a shift in real estate coming. People are just burnt out. The same can be said for AI, though. There's a little bit of AI hype that people are burned out about, but we'll see how that goes. My man Rajil in the chat. I finally got this working, which is kind of cool. I can now do this in real time and show you down here the displays, which is kind of nice. So I got Regilia there popping up, and I can make it go away pretty quickly. And just by clicking on it in my infrastructure here, which to me was very exciting. I know probably to you guys not so nerdy, but nonetheless, here we are. All right, so let's get back to this chart. I think this chart's important, and I want to cover this in a bigger view here. So I'm going to go here. I'm going to click on this bad boy, see if I can make it bigger for you. There you go. This is from John Burns Consulting. I like John Burns. I think they have good product over there. And all this is really doing is breaking this down. And we're going to go to the handy dandy pen here just because you guys love to see me use it. All right, from our boys over here, John Burns Consulting Research. All right, so of the 148 million housing sector units, 134 million households, okay, that's the baseline. You got 47 total million rental units right there. And of those units, the vacant ones are about 14 million total vacant units, but you've got apartments at 66%, single family rentals at 30%, mobile homes, boats, et cetera, at 2 million. So this is an important differentiation. And we're going to look at this over here on the other chart to the right here. So this piece here is where I think the value is. 14 million single family rental units by investor type. So he's only talking about this little narrow sliver of the rental market. And that's meaningful. Blackstone doesn't play a whole lot in there. Blackstone and other competitors play a whole lot in here. In multifamily. Multifamily is my background. It's my subject matter expertise. If you can argue that I'm an expert in anything, that's probably what it is. But I could also hear that I'm not an expert in anything as well. So this is really interesting. So if they're going to take away just this piece of the business, number one, I don't understand the hysteria going around companies like Blackstone. I don't really understand that because most of the rental income is going to be unimpacted by this. So, and again, depending on how you justify and define institutional investor, 1,000 properties or more, or 100 properties or more, you're really only talking about a tiny sliver of the market. Most of the market, believe it or not, is owned by people who own 1 to 9 properties or 10 to 99 properties. Okay? And I'm not saying these are all the guys on social media you're talking to, but large institutionals are only right there. Okay? They're not actually even less than that. Let me rephrase that. Large institutionals are only above that line. So you've got a very tiny percentage, somewhere between 3% if you define it as 1,000 properties or more, or if you define it as 100 properties or more, it's about 7%. So again, these are not materially moving the market. These are not going to impact things. If you want my honest opinion, this is lip service to a popular rhetoric that was and continues to be on social media and a narrative that seems to be unsubstantiated by this. And again, don't get me wrong, I am not a housing pundit per se. I am somebody who believes in the American dream. I am somebody who believes in capitalism. And if we're going to limit companies from doing this, I want to see that it has materially impacted the market in a meaningful way. And I continue to see data just like this from John Burns and co., which suggests that that's not the case. And I have yet to hear and or see data which suggest anything otherwise. Yeah. Does it suck that institutional investors come in and do this? Yeah. But guess what? Spoiler alert here. This has always been the case. It may be a percent or two more than it has historically, but it's never really been a huge, meaningful issue, at least in society, that's prevented affordability. The bigger issue with affordability is home prices going up, interest rates staying up, and this Molotov cocktail of wage inflation not keeping up. That's just my humble opinion here. Lance Lambert, again, the biggest question for Pulte is, what would an institutional ban treat build to rent and impact housing supply? How would it impact that? 95.7% of institutional landlords, AMH's single family acquisition through the first 3 quarters of 2025 came via its in-house home building unit. So AMH wholly owned 60,664 single family homes at the end of Q3 2025, up from 60,596 at the end of Q2 2025. So that's actually a really valid point. Let's change this screen here, dive into this bad boy. There you go. This is pretty interesting. So homes acquired through traditional acquisition channels or its national builder program, right? So excluding this block here, which was a one-time event of a bulk purchase acquisition, homes bought through traditional acquisitions are only this tiny sliver right up top, not significant. Build to rent homes, meaning they built the homes intending to rent them after they build them, are here, okay? That is not supply they're going to build to provide the market as far as rentals go to keep rental rates down if they're not going to be able to do this anymore. So who's going to build that supply to keep rental rates in place? Because here's what's going to happen, right? If you pull out this 7% of the market who's got 100, well, it's in case 100 properties or more at 7%, or 1,000 properties or more, 3%. If you pull out people who are building to rent, you now have less rental properties on the market, which means rental rates will go up, not down. This does not protect the consumer in this particular regard. Homes sold dispositions, that's pretty big, right? So think about this chart in one different context. Let me lay it out for you. If you're building this amount of units up top, and you're selling this amount of units into the market down below, that means you are providing additional supply, helping to keep housing prices low and or stable. You're not materially taking up more than you're selling. Whereas in this particular year, again, a bulk sale you had to exclude, they took up way more than they sold. So there may have been an impact as a result of that. But that was a one-time bulk acquisition of somebody else's portfolio that's not necessarily indicative of the market. Again, this is only one particular channel. So I don't think that what you're hearing and seeing in the media and what you will see leading up to Davos about this topic is really supported by the facts. There's a lot of people on X in particular who don't like that. I get that. I get the pain points and I get the frustrations. But that being said, this is what it is. Okay, so let's get back to the social view here, and we'll take a look down here at the chart. Macro Edge, Amazon is eliminating 2,400 jobs in Washington State, a decision tied to a 10-year investment into artificial intelligence technologies. We've covered this a lot lately, a whole lot, and I think it's safe to say we're seeing this stuff manifest. And if you've been watching the show for any length of time, I know that we can at times be somewhat bold in how we phrase this stuff, and that we can say, jobs aren't going to improve meaningfully. But when you see stuff like this, it's because we know that this is coming, and we feel like it's better to address it head on and be transparent about where the job market's going. I truly believe, and I don't want to speak for Sai when I say this, that there's been a decoupling of the FOMC's responsibilities of stable employment and stable prices. I think that price stability is going to change dramatically. I think GDP will ultimately be impacted. 70% of 70% of GDP is consumer spending, and if you remove that from the equation because people are struggling to keep up financially and jobs are harder and harder to find, you are going to enter a world where inflation continues to, I guess, stay the same or creep up incrementally, but unemployment creeps up. And then how do you resolve for the two of those in an economy where you have all-time high earnings in some cases, less distribution of dividends because there's so much capital expenditure into things like AI? I don't know where it goes. It's an unknown right now. Anybody who tells you they know it for sure they're lying to you, okay? All right. Let's get back to this today's production schedule. There are some other things I want to talk about, which I think are important. Let's talk about the latest news with Netflix's acquisition, which we just saw headlines today. Warner Brothers rejected the offer from Paramount. I'm going to cover this as well in the notes, so forgive me while I do a little bit of homework while we're sitting here talking. I'm going to put this. What I do is I keep a constant set of notes here so that I can update everything later on and give you guys updated show notes that I think are reflective of what we talked about. So anybody who watches the stream later on can do their homework as well. The last thing I wanted is anybody to say, hey, Chris, you know what? You're full of it. You don't know what you're talking about, which is true, but not because I'm not referencing meaningful data. So Warner Brothers rejected Paramount's takeover again and tell shareholders to stick with the Netflix bid. So let's actually look at this. I've got the ability to play stuff now, which is kind of cool because before I didn't because there were problems. So shall we see if we can get this right the first time? If you guys are in the chat and you guys are watching, it would be very helpful to me if you would let me know if you guys can hear this. Okay, let's get to it.
Talk about Warner Brothers and Netflix and Paramount right now. From your vantage point, what's the most realistic end game here? And where do you see the biggest investor confusion arising?
Well, the Warner Brothers board sued into oblivion is the most likely outcome. I have no idea how a board with a straight face can tell shareholders to take an $83 billion offer instead of a $108 billion offer. I didn't major in business in school. I do have an MBA, but last I checked, 108 is a bigger number than 83. So I don't understand this at all. Their idea that, oh my goodness, Paramount doesn't have the financing lined up. What the hell is wrong with them? Yeah. Larry Ellison guarantees $40 billion. He'll get the other, whatever it is, $60 billion. It's really silly, and I have to believe there's something going on with Warner Brothers board and Netflix. And I don't think Netflix would ever do anything wrong, but I think the Warner Brothers board has already demonstrated they'll do something wrong. So the outcome of this is Paramount wins. I don't even get why we're talking about the drama. Oh. And we're going to see the Warner Brothers board apparently reject the Paramount bid today, and then they're going to get sued into oblivion. Even if they accept the Netflix bid, I think that the government blocks the deal, and not because Trump is friends with the Ellisons, but because Netflix is trying to define the market as how we consume all filmed entertainment. So they're including YouTube in there, not YouTube TV, but regular old YouTube and TikTok. They're nuts. The market is streaming, yeah. And the streaming market is number 1 and number 4 are Netflix and HBO, number 1 and 2 by profit, and the two of them combined are bigger than the rest of the industry combined. So taking over 50% share of streaming gives them tremendous leverage over content and tremendous leverage over subscription pricing. So the government's gonna block it because it's the right thing to do. And hey, mark that in the column of, not on your bingo card. The government's gonna actually do the right thing and block this merger because it doesn't make sense for consumers or content providers.
Wow. Homeboy came out firing. Look at him go. But you know what? He ain't wrong. And I'm going to explain that in detail for you here in a minute. But before I do, hey-oh, look at this. You guys could hear it loud and clear. And I got to tell you, That was not an easy thing to get wired in. I had to wire stuff in and out of the computer to OBS to get to you. It was not what I would call fun, but I'm glad to hear that it's working, and well, literally hear that it's working. So thanks for everybody commenting in the notes. A lot of people on Instagram and TikTok don't feed over to this chat. If you want to be in this particular chat and you want your comment highlighted, you've got really a couple choices. LinkedIn goes in, but I can't go out. YouTube and a couple other channels will stream to it, so that'll help you out. But YouTube's probably the easiest one. All right, so what he's saying is absolutely correct. There is a fiduciary responsibility as a board to look out for the shareholders, and we're going to talk a little esoterically here, but I think it's important to get the kind of the macro picture. If your board is rejecting an offer, you have to have what I would call sound and material reasons to do that. You can't just do it because you like one company more or less than another one. It really comes down to the economics. And I hate to say that because there are always some intangibles in the decision. Like, I don't know if you ever liked the movie Wall Street, Blue Steel, remember that? Well, if you are looking out for the employees because you want to retain more employees and more jobs, you actually don't get to consider that in a meaningful way, because if it means more return for the investors, the shareholders, institutional and retail, then you've got a fiduciary obligation to ensure that their financial interests are looked after. I know it sucks, but that's corporate America. That's the responsibility of being on a board. I've been on boards. I've been an executive at a publicly traded company for long enough to know that it's inhumane process. So, and this gentleman, whatever his name was right. It's going to be challenged by the government at some point in time. At least it should. And the reason why is not because of the participants trying to buy them, but because Paramount has a higher dollar offer, and the purchase by Paramount would leave them with less overall market control of streaming versus Netflix getting 50% of the market share. That's a monopoly. There are antitrust laws in place to prevent that. And that has to be a consideration by the board. What is the probability of getting to the finish line, the execution, right? If there is a less likely chance of closing on it, then guess what? Therein lies the problem. What up, Sean? Making it through to the restream. Boom, there he is, my guy. Missed a couple live streams. We got you. Thanks for coming in, brother. So we're talking about the Warner Brothers rejecting Paramount's takeover bid. So let's go back to that screen real quick, because I think people joining will need to hear that. I got to get to the point, by the way, guys, where I start doing some of the stuff in advance and put the stuff down here for you to take a look at. I haven't been able to do that because there's a whole section here that I built out which allows me to come up with chapters. We're going to have chapters that go up the top across the screen under some circumstances, but I kind of wanted to get the cadence going first before we started messing with all the extra stuff. So if there's anything you want to see, these are the days and weeks to tell me exactly what it is you want to see and why. But this is where we'll see it. So let's talk a little bit about this. I'll read a little bit of this, and then we'll get back into why there are much, much bigger troubles ahead for this. New York, Warner Brothers again rejected the takeover bid from Paramount and told shareholders Wednesday to stick with their rival offer from Netflix. Keep in mind, shareholders have to vote on this. Warner Brothers leadership has repeatedly rebuffed Skydance-owned Paramount's overtures and urged shareholders just weeks ago to back the sale of its streaming and studio business to Netflix for $72 billion. Paramount, meanwhile, has made efforts to sweeten its $77.9 billion hostile offer, an offer that's aggressively coming in and something that they don't want, hence the term hostile. Warner Brothers Discovery said Wednesday that its board determined Paramount's offer is not the best interest of the company and its shareholders, not in the best interest. It again recommended shareholders support the Netflix deal. Okay, so let's pause here. I have been sued in an activist shareholder lawsuit. I grew up studying people like Carl Icahn, obviously being in the business. These guys are legends. I know there's a lot of stigma around them, but I will say that this is a situation that's perfectly ripe for that situation to happen, where an activist comes in and says, hey, we as shareholders, I own your stock. You could have sold to more money for, than you got with Netflix to Paramount. And you could have made us, the shareholders, more money in that execution. And there was more closing certainty with a Paramount-backed deal than there is with a Netflix-backed deal because of antitrust laws. If Netflix has to have certainty they're going to close, right? If there's closing probabilities here, issues, then you got to take that. That's one of those intangibles you can take into consideration. You can't take in who's going to lose their job and who's not going to lose their job, but you certainly can take in the probability of success on the merits of closing this trade due to potential challenges from the government of antitrust monopolies, right? So this is perfectly right for that. An activist investor can come in and say, I want to know what's going on. I want to get board documents. I want to get into this. Carl Icahn was a legend. There's a movie called Icahn that came out, I think it was on HBO, which did a little bit of a look back, kind of an autobiography on him, because he actually participated. It's really fascinating. If you ever wanted to look into activist investors, that's a great place to start to kind of get an understanding of what they are. They get a lot of a bad rep, but if done the right way, and for ethical reasons, which is always questionable in this business, then could be good. Could be good. So Warner Brothers Discovery said Wednesday that its board had determined Paramount's offer is not in the best interest of the company, right? Well, okay. Again, this originally started because they said Larry Ellison wasn't providing a personal guarantee, and his son, who controls controls Paramount's offer, was saying that it was coming and it didn't come. Well, it's there now. We know that that's there. So you got one of the wealthiest men in the world backing this deal with a personal guarantee. He can get the money. You can't reject it because you say, we don't think they can get the money, unless you've got a reason to say that. And if one of the richest men in the world is saying he'll get the money, it's going to be hard to convince anybody to do this. Now, again, they have to convince the shareholders, so start there. Paramount's offer continues to provide insufficient value, including terms such as an extraordinary amount of debt financing that creates risk to close and lack of protections for our shareholders if a transaction is not completed. So that's interesting. They're saying they can't go with Paramount because there's a low probability of execution on their end, but they're not responding to what is likely to be a challenge to the monopoly of Netflix owning 50% of the streaming market if they were to close on this deal. So this, if you read between the lines, basically says, you guys are financing this, Netflix has cash. That's a risk. That's true. They're saying, oh, and by the way, there's lack of protection for our shareholders if the transaction is not completed. I think that is what's being angled for here, is they're basically saying, hey, look, Netflix's offer contains termination clauses, language to us that says, if this doesn't go through, we get paid a whole hell of a lot of money, right? Well, if Paramount is not offering that because they don't want to, or because they don't think there's a lack of execution risk there, then that could be what they're angling for. They could be saying, hey, we got this offer from Netflix and it pays us a whole great deal amount of money if it doesn't go through. So if you're in Warner Brothers, right, you could say, look, we don't think either offer is strong. We're playing the offers off one another to get what we want from Paramount. Both of them have execution risk. Let's see if we can use the media and the rejection of this offer to get what we want from Paramount, which is more protections in a worst case event scenario that this does not get approved. Because there is antitrust risk on both sides of the equation. There is greater risk owning more market share with Netflix. So this could all be gaming the system, if you will. You don't know. And that's why not being in the boardroom and not hearing how things go can be very different from the perspective that we as consumers see. And this is why activist shareholders go in typically very aggressive, is they're assuming some of the things that they see, like we see as consumers, but they don't always know. You'll find out as they go through discovery and depositions if you get there. So Warner Brothers Discovery Chair Samuel D. Piazza Jr., what a great name, said in a statement, in contrast, he added the company's agreement with Netflix will offer superior value at greater levels of certainty. So again, going to that risk of fallout. Again, not addressing antitrust, but certainly playing off that risk of execution conversation that we've been having. Paramount did not immediately respond. Of course, why would you? You're in the middle of this whole thing. Warner Brothers shares currently have shareholders have until January 21st to tender their shares, meaning vote in favor of this. Late last month, Paramount announced an irrevocable personal guarantee from Oracle founder Larry Ellison, which was the reason why they originally rejected this and said that it was not likely to close. Again, that guarantee is there to back a $40.4 billion in equity financing for the company's offer. Paramount also increased its promised payout to shareholders to $5.8 billion if the deal is blocked by regulators, matching Netflix breakup fee. So there you go. If that is now matched, despite what the CEO and the other statements said about having uncertainty and risks that don't pay the shareholders as much, I would argue you got a problem here. You're going to have to justify why you're going to go with Netflix and not with them. If the breakup fee is the same, they're paying more money, you got the guarantee of one of the wealthiest men in the world, which is what the gentleman in the video was talking about earlier. In its Wednesday letter to shareholders, Warner expressed concerns about a potential deal with Paramount. Warner said it essentially considers the offer a leveraged buyout. That's referencing debt. They're raising debt to do it, which includes a lot of debt, and also pointed to operational restrictions that it said were imposed by Paramount's offer that could hamper Warner Brother Discovery's ability to perform throughout a transaction. I don't know, man. I've been in this business a while. Reading between the lines, that's a really weird statement to make. So I don't know. We'll see there. And I am gonna get back to the comments in a minute. I just want to get through with this. I think it's important. Hey, what's up, Sean? Commenting like crazy. I love it. The battle for Warner and the value of each offer grows complicated because Netflix and Paramount want different things. Netflix's proposed acquisition includes only Warner's studio and streaming business, including its legacy TV, movie production arm, and platforms like HBO Max. But Paramount wants the entire company, which beyond studio and streaming includes networks like CNN and Discovery. If Netflix is successful, Warner News and cable operations would be spun off into their own company under a previously announced separation. A merger with either company could take over a year to close and likely will. You have to get government approval, go through this whole M&A process. It takes time. And it will attract tremendous antitrust scrutiny, the monopoly laws that I've referenced along the way. Due to its size and potential impact, it will almost certainly trigger a review by the U.S. Justice Department. I guarantee it. And I guarantee they're watching, which could sue to block the transaction or request changes. Other countries and regulators overseas might challenge the merger, blah, 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 blah. We don't need to go on the rest of that. I think that's pretty much. Oh, here we go. In a statement addressed to Congress, a Congressional Antitrust Committee subcommittee on Wednesday, Cinema United, which represents more than 60,000 movie screens worldwide, reiterated it was deeply concerned that Netflix acquisition could harm both moviegoers and people who work in theaters. Interesting. And that's probably true. So Netflix has a shorter. So they just did this with the Stranger Things distribution. They have a shorter release time, usually about 2 weeks in movie theaters, and then it goes straight to streaming platforms, right? For them, they're going to get whatever revenue they can in theaters, but their main constituents are the streaming platforms, which is where they originated. We're still trying to figure out where Hollywood and movie theaters end up. And it might be a more immersive experience one day, but to their point, if they control 50% of the market, i.e. Netflix, then you're going to see more movies get into theaters for a shorter duration before they go right to the streaming platform. So there is some risk here to jobs in that sector. And movie theaters have been struggling for years. Way before the pandemic, there's been challenges in that space, but it's been revitalized in a lot of ways. Let's go to the comments. One of my favorite guys, O'Dwyer, who's one of the strongest men in I think it was Ireland. He recently passed away. He was 40 years old, had 3 kids, really sad. And he would always go, let's see the comments. And he also said some inappropriate things I can't say on the show. But it's sad to see influencers pass away. Love or hate influencers, if you will. It's crazy. But anyway, let's go to the comments here. Sean, let's get to yours. Let's see here. Last one. I'm going to go down a little bit here. Honestly, with AI, I see a huge push for personal entertainment versus old mainstream entertainment. Yeah, and I can see a world where entertainment's going to, kind of change. A more immersive experience is important, and I think this is what we're doing here is a great example of that, right? Like, so with this platform, we wanted to replicate something that was like traditional media, and that we gave you information, and we tapped into things like some of these articles here. But it was more of a companion product to a pre-recorded thing that we put out, which is a show, which is more intimate. But we also didn't want to lose the intimacy. So that's why we didn't do like a news desk setup. I'm sitting at the production space that Regil sits at in the recording studios over there, because we feel like there's a happy world where you get like Sports Center, you get social media, real-time feedback like this, comments where we can engage. And you can also bring people in. We're going to do that at some point in time, calls now that the audio is working. And you get to have a more engaging conversation. Whereas if you go to CNBC, they're talking at you, not with you. That was kind of the thought process. And I think movies are going to go the same way. You're going to see a lot more engagement. Maybe the opportunity, we've always said this, to choose different paths with AI creating things on the fly. Everybody can have a different movie going experience. You never know. But certainly that landscape needs to change. And let's be honest, I'm going to be the guy who says it. Going to the movie theaters in some cases sucks. Regil, he knows my guy. Famous word. Yeah, that was Pa's word. He used that word in a thoughtful and classy way. But he actually did to defend a lot of the community and a lot of the bad habits there. But yeah, to your point, that's absolutely true. Pa, what a stud. I'm gonna miss. There's very few people that you see on social media that you don't have any connection to that you say, I'm gonna miss that person. And I think he's one of those people for me. It was kind of emotionally rocked me a little bit. And I was still reeling from the whole Stranger Things. Oh, chat, by the way, my sister's in the Instagram chat. what are your thoughts on this whole like conformity gate thing? I mean, today's the 7th. Are we going to get another Stranger Things episode? I'm thinking no, but the rhetoric around it is cool. It would have been really, really cool to see them do that if it actually happens. But if it does happen, I would assume it would happen tonight at 5 p.m. But I don't know that we're going to get another episode. So maybe it's just me. Let's see here. I'll check the Instagram chat real quick. I can't feed Instagram over here without copying and pasting, and I'm lazy, and I got a pencil, so not the best strategy. Persia, what's up, sister there? Vic, from a legal perspective, what are some of the consequences for the lawsuit pertaining to rejecting the merger? That's actually a good question. So, having lived through that, I can tell you it's a prolongated process. Their activist shareholder will come in, they'll try to buy more and more stock if that's the way this goes. If it's lawsuits from the federal government, they're basically just going to say it's a monopoly, it violates antitrust, and I can tell you based on surface level, the amount of ownership that Netflix would have of the streaming market, depending on how you define the market, that is 100% going to violate antitrust. You own too much of it. We have these monopoly laws put in place. Now, the question is going to be how do you define streaming platforms versus traditional platforms? And I think that's where this is going to get really wonky because like when Uber and it's probably worthwhile to get a little more detail. When you have emerging technology like we have, okay, and all this technology comes out at a really fast cadence, you've got new markets that develop. And as these new markets develop, you don't have things with a multiple of performance you've seen historically. Allow me to explain. So when Uber came out, you never had a ride sharing, vehicle sharing, taxi like service, right? And Lyft, same thing. You didn't have a previous IPO for a company like that. You didn't have a stock that was publicly traded like that. So you didn't really know what a good valuation for the company was because it was in uncharted territory. And because of that, you see this uncertainty in how things should be priced. And sometimes it works out well, sometimes it doesn't. But these things typically get to market by having a seed round and a round A, a round B, a round C. And as this goes through, you get less and less ownership from the people who started the company, the founders, and more ownership from the stockholders and the institutional investors. By the time it gets to you, the consumer, the value is usually bled dry because they have an increasingly larger values, usually based on revenue if you're smart. But as this happens, the valuation of the company gets bigger and bigger and bigger and then goes to market. In some cases, it's been overvalued by the hype, right? That's not good. You're going to see a lot of these types of valuations come to the market in the next couple of years in uncharted territories. Right now, we're seeing prediction markets be a really big thing. Will a company with prediction markets go public? Robinhood's certainly trying to do part of that. Shout out to Robinhood and Vlad and his team over there. How is that going to impact things? How does it impact insider trading? We don't know. These are really, as technology continues to evolve and things continue to change, uncharted territory like this is going to really impact the markets. It's going to give a certain amount of uncertainty. Netflix is a great example of this. You've got a streaming platform that started off as a mail DVD, CD platform, right? And has now evolved into what it is today. You look at Amazon, you could argue Amazon is a monopoly of sorts, right? They kind of own the market. There is not really a competitor for what Amazon does. They're allowed to operate. That doesn't violate antitrust, but then I guess it all depends on the framing of it, right? Netflix will do their best to frame their streaming platform as not being a monopoly, there being other outlets. And they might look at YouTube and say, well, YouTube has all these things like this show, which streams. And that because these shows should be counted as streaming entertainment and content, that it might not actually impact the market as a, quote, monopoly. They don't own 50%. They probably own closer to 20%, which shouldn't violate antitrust. All of this will be debated as time goes by, and that's how the lawsuit will go down. Most likely is a Justice Department. I don't know that an activist will get involved here. You never know. You piss off Larry Ellison, he might sue. He might sue right out the gate, and he might be the activist, and then you'll see the activist buy more and more shares over time. You don't really know. It's kind of weird. Yeah, Regil, robotaxis. That's actually a good point here. I'll put that up on the chat here. So Uber, Nuro, Lucid, robotaxis coming to San Francisco soon. Yes, and the West Coast has way more of this than the East Coast. Our East Coast listeners don't see a whole lot of that. But this is becoming a problem, particularly if you look at Elon Musk's way of doing this, where he has robotaxis going into service and sending your car back. This is the reel that we posted yesterday. If you're on actually any of the platforms, you'll see that yesterday we posted a reel because Said and I talked about this on episode 316, which I will likely plug whenever I get back around to that and setting up this live stream later on. Anecdotally, I'm going to ask the chat one question before I move on too. I think it's important. One of the things we're doing on the YouTube platform, if you go there, is I decided not to use thumbnails on these things. I want this to be a community for you guys as much as it is for me. So in doing that, if you think the thumbnails where I'm like, hey, midstream are weird, we'll happily put thumbnails on there. But I think showing it like this, showing it that it's alive and that you're having actual engagement conversation with us is more important. But let me know your thoughts on the thumbnails for YouTube. And certainly if you're watching this on a different platform, I've tried a couple different variants now of scheduled and non-scheduled lives on LinkedIn. And on X, it works surprisingly well. I was actually really surprised by X. X streams at 1080, dude. And it actually does really well. The only problem with X is X will take the most static frame and use that as a thumbnail. You don't get a choice. And I paid for the Premium Plus because I'm an idiot. I paid an extra $500 a year for it. And it still shows our end credits on X as like the thumbnail for the video, which I think is really a disservice to what we're doing here. But I blame Regil. Regil, it's your fault. So one last question, then we'll move on to the next topics here. Probably want copyright, so they'll still make money off individual content. ChatGPT and Disney, you can make your own stories or porn. Yeah, well, there you go. Yeah, no comment. But yeah, actually, in a couple of weeks, actually maybe 2, I've got some interesting stories to share with you guys as it relates to some of our stuff, trademark activity, defending our intellectual property, and some of the reasons why we've done some of the things that we've done behind the scenes that I want to share. I think from a business and strategy perspective, if you own a business or you ever thought about owning a business, what we've done in the last couple of weeks is really something that you need to understand and be cognizant of, right? You got to defend your intellectual property, and you've got to be able to own your intellectual property. This could be as simple as a word for a trademark for your name. It could be owning the websites. It could be a lot of different things like that. But a fun fact that most people aren't aware of, and this is an unfortunate reality of the legal system that we're currently in, is if you don't defend your intellectual property, you will continue to degrade your ability to defend it later on. So if you see somebody violating the rights of a company you started, using a similar name, using a similar website, using something that builds off of your inherent IP, then you've got a fiduciary obligation to yourself as the only shareholder of a small company or the shareholder of a larger company to defend and stop that stuff. So we're going to talk a lot about IP rights in the future and some of the international ways of dealing with that yourself, where you don't actually have to hire attorneys. From an attorney, I will tell you how to do some of this stuff. So we'll get that on a future show for IP stuff like that. All right, let's go to the markets, shall we? All right, and anybody on Instagram, I am watching the comments if you guys want to say something. Let's see here. I do want to spend some time on CNBC's website. I don't know if you guys spend any time on that website, but I actually really like CNBC's website. I think it's very intuitive, and it's clear to see what's going on in the markets and the headlines. But I wanted to share something with you guys. This is CNBC's website. At the top, some of the things that we constantly check. You ever wanted to look for some of the things we talk about in the show? If we're not on the live stream and showing it to you down here, you can easily look up and see like some stuff like the VIX right here, right? This is the VIX. This is a fear gauge, volatility index. This was a pretty high point not too long ago. I think it was around 30. There you go. Yeah, 30. In the fear gauge. Below 20, no one's concerned. No one has long-term fears. Okay. Let's look at the last 3 months here. There you go. You see some spikes here. And you look these dates up, you can see there's interesting things that happen in the market. But again, open, close, 26.20. Open, close, 25.20. Right? You get down here to the 20s. Anything below this, in my mind, there's not a lot of fear going on here. We just went into Venezuela, took their oil, and took out what seemed to be a pretty ruthless political regime. And in doing so, I think the market thought there was going to be a lot of reaction and a lot of stigma, but now we're trading at highs. So let's go back here to the previous screen. Dow Jones is down slightly. S&P is down slightly. NASDAQ's up. NASDAQ, again, we talked about this. Investing in the QQQ top 100 in NASDAQ might be the way to go. Look at the difference here versus everybody else. They're red, but look at the growth here. Let's go 5 years out in the NASDAQ. I think this is important to share. Look at that, right? You couldn't buy a home the last couple of years and you went into the NASDAQ, just the index. You made some equity there in the form of returns. The problem for most Americans is they can go into their homes and they can see the value on Zillow, but you don't really know per se. With the stock market, you see it in real time, and it's a lot more anxious, and there's a lot more stigma attached to it because that's the actual value that day as opposed to getting an appraisal on your property. You got to start thinking about the investments you make, whether that's holding stock, whether that's holding cryptocurrency, whether that's holding your home price, as realized or unrealized losses and gains. None of it matters until you really need it, and that's when this really comes down to, right? If you follow the old school methodology and you live off of the cash flow and you invest excess cash flow because you've controlled your expenses, then you wind up in a situation where the realized or unrealized losses are less impactful to your daily living. That's the American dream. That's what we're really talking about when we talk about home ownership, is the ability to have something build for you and not focus on it. Let's see here. It's weirdly calm. It is weirdly calm in the markets, Sean. And I can't tell you exactly why, other than the fact that the market's starting off with this positive rhetoric. And look, we know there's a bubble. We know what's going on here. S&P and Dow touch fresh records, but rally this week loses some momentum. It actually lost some momentum while I was on this live, so you can blame me for that, I guess. S&P and Dow touch fresh records, but the rally this week will lose some momentum. Live updates. Here we go. This is from CNBC. Let me put that in the show notes before I forget, because you guys know that I do that from time to time. Let's see here. All right. And I love the live update section here from them too, because it's just the narrative and none of the commentary, which frankly is a lot better for, I think, what we do here. But the S&P and Dow Jones Industrial Average notched fresh all-time intraday records on Wednesday, building on their strong starts to 2026, though the rally has lost some steam. It lost some steam while we were on this. I think it really rallied a little bit more in the morning when Trump talked about what he's going to do in the housing market and the Davos conversation. And some of the oil responses that we've seen here. There's been talk about the quantification of the amount of barrels that we're going to get as far as the country goes and how much exports we're going to get. So I think that drove a lot of that optimism. I'm not seeing a whole lot of other things that are driving it. The broad index was last trading around the flat line after rising about 0.3% to a record high, while the 30 stock Dow fell 329 points or 0.7% after it gained more than 150 points or 0.3% to reach new highs earlier in the session. The NASDAQ composite gained 0.4%. So NASDAQ was the outlier here. And again, technology. So surprising, not really. Shares of oil refineries Valero and Marathon Petroleum among the winners of the day, gaining 3% and more than 1% respectively, because again, we quantified the amount of oil that was coming out. And refiners, like we talked about in the previous live stream, I don't know that it's going to be the shippers, and I don't know that it's going to be the suppliers, but the refiners are going to get more work here. People who sell raw petroleum gas to the consumer are likely to see prices go down as volume picks up. So I see that being flat at best, and maybe even a benefit to the overall consumer as far as cost of energy goes. But I think the refiners are where the money's going to be at, and I think the market's starting to realize that. In contrast, crude oil prices dropped on the heels of President Trump saying that interim authorities in Venezuela will be turning over as much as 50 million barrels of oil in the U.S., spurring concerns over increasing oil supply. There you go, right? So these companies go, okay, you know what, we're going to get a ton more oil. Our prices are going to ultimately go down. So you saw crude oil prices drop as a result of that. And let's check here. If you're looking for fun stuff in my history, you're not going to find it. I apologize for that. But all right, oil, there you go. So crude oil, you got oil down 56.21. Natural gas up, but there you go. There's your oil. WTI crude, 56.21, down 1.63%. So nothing terrible per se, but over the last year, look where oil's gone price-wise. It's gone down. Pretty interesting, right? Year to date, it's only been a couple days, kids. But yeah, that's Venezuela right there for you. So the market is doing exactly what we said they were going to do in the last live. It's trending down as a result of what we're seeing here behavior-wise. The lack of significant movement in the price of a barrel of crude oil, in our opinion, is a vote of confidence that we're still far from being tight from a supply-demand standpoint, said Keith Buchanan, senior portfolio manager at Global Investments. Never heard of him. Have you? Anyway, no offense to Global Investments. There's significant risk of oversupply, which means values will go down. While oil prices extended their losses from Tuesday, stocks climbed in the prior trading day as investors seemed to shrug off worries about the U.S. attack on Venezuela over the weekend. Really, what's interesting, I don't know if you guys have been following it, but there's a lot more social unrest in Iran right now that's captured mainstream media attention than there has been in Venezuela, where the president was extradited to the United States for sentencing. And there's a whole vice presidential campaign coming through there and conversations that have happened there. But it's interesting. What's happened is South America has changed the prospect for growth in the U.S. from an equity market standpoint. Buchanan also said, I think that's accurate. I think there's some complacency from appreciating the overall geopolitical risks that are growing, in our opinion, but we don't feel like what's happening in Venezuela has moved the needle in the regard, up or down. Yeah. So kind of like we talked about on our live stream over the weekend, that this was materially a non-event. There wasn't a whole lot happening here, which is shocking, but that's just how they responded. And this is not Libya, this is not Iraq, and this is not Iran. So very different culture and very different response. The Wednesday sessions also saw bank stocks give back some of their strong gains for early 2026. JP Morgan, Bank of America, Wells Fargo were key laggards, each falling more than 2%. So we are officially at 12:09 p.m. Pacific time. We got about another hour or so till the market closes. I have been doing shows like this for about an hour to kind of test it out. The goal is to build up a cadence to where we get to 2 hours. But I do want to spend some time talking about this last piece because I've been asked in the comments a number of times to clarify. So we're going to do that. One of the things I think is important to a lot of people is understanding how banks and why banks are being pointed to in this particular economy as a strong case for future growth. So I like to differentiate between large banks and community regional banks. So think of community regional banks as, let's just say below 30 billion to use kind of old regulatory thresholds, but certainly 30 billion to 100 billion in asset size can be considered a community or super regional bank. And there's lots of different opinions about what that is and what that looks like, but neither here nor there. I think you got to differentiate them. So let's do a little bit of drawing here on the screen so you can see my face with color all over it. Is you're going to focus on things like the community banks, and you're going to look at the GSIBs very differently. The GSIBs, the globally systematic important banks, think Wells, think Chase, think B of A. They perform very differently than the community regional banks do. The community regional banks have a lot more volatility in price, subject to things like narrative, retail traders, and the hysteria that may or may not be present on social media. The GSIBs do not. Think of them as anchored to the community, right? They're globally systematic important banks. You know they're not a likelihood of going anywhere soon. So these tend to get all the scrutiny, and they tend to get all the volatility. You saw this during the Contagion period, which took down Silicon Valley Bank, First Republic Bank, and other banks in the sector. Now, let's do a little bit of a homework, shall we? The Fed funds going up or down impacts the cost of banks to borrow, which makes the ability for banks to make money and their willingness to lend money out more or less tight as a result of that. For the purpose of this conversation, we're going to focus on a phrase, net interest margin, NIM. This is very common in the banking sector. This is where banks make their money, right? Because what they're doing is they're paying out money on deposits in the form of interest, right? And they're taking in money in the form of loans, right? So what you typically see is you'll see deposit pricing that is usually about 2% different than what you're going to get on loans. So if they're making loans at 5%, your deposits will be capped at somewhere around 3% for new deposits. And the reason why is it takes about 2% to run an institution with kind of an average ballpark figure. And there's ups and downs in efficiency, but 2% is what you kind of want to calculate as a baseline bare minimum in order for profitability. Now, what happens is over time, you raise deposits, right? And as you raise deposits, you have a weighted average interest rate, right? That weighted average interest rate takes time to catch up with the market. So if banks are all offering new rates of 3%, you might have rates at 1%. You might have rates at 2%, and any velocity thereof. You have things like CDs, which have guaranteed pricing through maturity, and those will reprice over time. But you never really get to the market rates. You always get the weighted average interest rate creeping up over time. Now, what happens is Same thing, the loan portfolio, right? You're making loans yesterday at 5%. Today, you're making them at 4%. It's a weighted average interest rate on those portfolios. But the delta, the difference between those two, right? What you pay on deposits versus what you make on loans, right? The difference is your profit, right? And that profit has to go to pay things like your operating expenses and everything else. NIM, because the Fed is cutting rates and the treasuries are holding, is going to increase their profitability near term. We also have an aging cohort of senior executives and leaders in the banking sector, which are going to look to get out, to look to retire, and you're going to see consolidation. So I think the banking sector, oh, my man, Jeff Sonnenfeld is my dean at Yale School of Management. Oh, talking about the ban on large homes. I got to have Jeff on. What up, Jeff? In any event, he's on CNBC right now, looking way more handsome than me. Arguably a really terrible camera, too. That's a whole different conversation. But so look for the banking sector to heat up. Look for M&A in that sector to heat up, and look for this to be a big breakout year for them. Unless you see losses and foreclosures start to mount. I think a lot of them are worried about that because of some of the consumer trends that we're seeing on consumer credit and some of the stuff like that. But and auto loans, for example. So I think you're going to start to see some of that happen. You're going to start to see a lot of M&A activity in the small community regional banks. There's some money to be made there. So food for thought. You're going to hear a lot about the financial sector as kind of like an anchor. So everybody's so got AI fatigue that you're going to hear a lot about other sectors that are going to make money. I think petroleum producers, refiners in particular, are going to see some profits. I think banks are going to see some profits. I think energy sector, particularly electrical, is going to see a lot of profits. So we're going to see a lot of things change here for quite some time. Let's go to the overall observational portion of the show, where I like to look at the markets here. We're going to do two things to wrap this show up today before the market closes again at 1 o'clock. We're going to look at where some of the things that I track on a daily basis are. I think it's good to get a ballpark. At the very least, if you just don't understand them, you hear me say them today, then the next time you come back, we talk about them again, you will learn passively, kind of like osmosis, by just hearing us talking about them, by getting a ballpark where the numbers fall and figuring out where normal is in that space. You'll understand where volatility is creeping in and how that responds. The goal is to get you guys into a place where you understand these things, you look at them too, and then anytime you have any financial related questions in your life, you're able to answer them because you did and looked at this stuff yourself, okay? So let's start off with the bond market. I always look at the 10-year Treasury. The 10-year Treasury, as my boy here, as Matt, who's not on this, will tell you, U.S. 10-year Treasury is the best proxy for mortgage rates you're going to get. As this goes down or up, you see the influence on mortgage rates go down or up as well. And there's a whole show we've done in the past explaining that concept. For now, you just need to worry about that's where the 10-year is currently situated at, 4.138%. Now, small movements mean big changes here. So this is a small movement, not what I would call meaningful. But if you saw, like, for example, this at 4.03 tomorrow or 4.2 something tomorrow, that's a move to be noticing. You will see people price mortgages based off this. So if this goes down, you might get a better rate on your mortgage if you're looking to apply for one. If it goes up, you might get a worse one. So be cognizant of this, the 10-year Treasury at all times. I think it's important for all of us as consumers to kind of watch that. It's a good proxy for the market. Let's go back here. You can look at some other things here, like Japanese currencies, other stuff like that. I typically don't. I just typically look at stuff like the Dow Jones Industrial Average. I want to know where this is at. I want to know how the overall industrial average is performing. 49,000, not too far from all-time high. 387 down, about 0.78% today. Not meaningful in my mind, kind of flat. Let's look at some of the other indices. Let's look at the S&P 500. Again, just shy of 7,000. I think you're going to get to an all-time high here, again, not too long from now. 6,932.52, down about 0.18%. So we're going to look at that. Let's look at a couple others that I think are meaningful. NASDAQ, we already talked about early in the show. This is up 77, about 0.33%. Again, not big moves, but certainly up 23,000. You're going to see that continue to move up over time is my likely guess, given where we're seeing this up here. VIX, I also watch, as we talked about. It is creeping slightly up from what we talked about earlier today. We've now approached 1521. Again, below 20, I'm not freaking out. I'm not terribly worried. Anything above 20, I'm starting to go, oh, wait a minute. But as of right now, you're seeing some small increase here in volatility in the fear gauge, as they call it. I'm not, again, freaking out about anything so far today. I think this is relatively stable for the day. Let's go and look at some of the things we talked about on the show. Let's see if I can find it real quickly. I really should put together a list that we can track. I actually, and I haven't talked about this publicly, I'm actually putting together charts for our show that we can have that are branded for us that I can just screen capture and then throw onto social media later on. But for now, we're doing this here. This is the Invesco QQQ Trust. This is the top performing 100 in the NASDAQ, 625 up 1.62. So again, relatively flat for today, relative to everything else. But again, this is something to be noteworthy of here. So this is up 0.26%, 1.61. We said this might be a good alternative to the old school S&P 500 methodology, right? Put into a low-cost index funds, guys, right? Well, the S&P 500 today is down. So those small incremental wins over time might be part of the reason that you get a benefit here. So neither here nor there, just something to look at. That's what I'm looking at today. Again, I'm watching the markets. I'm watching my friend Jeff Sonnenfeld from Yale on television today, but it seems to be a relatively mellow day other than some of the commentary. Look for us to cover live in the future. We'll cover the Davos stuff and we'll certainly play that audio. Look for us to cover the housing decisions if there is anything there in greater detail. We'll certainly follow up on any litigation and Justice Department commentary and the Netflix stuff. But until then, we have some comments we can get into. Let's bring up the chat. I haven't done that today yet, but there you are. There is some activity there. So for those of you guys in the chat, I sincerely appreciate you. I tend not to bring it on because number one, on the vertical platforms, I know you can't read it. On the larger horizontal platforms, it's hard to get context for, I think, the whole show because I'm also seeing all the other parts feed in from other platforms on other stuff like Instagram here as well. So I try to keep it relatively level and then I can just bring in comments here. Anybody have any questions, comments, concerns, thoughts, additives before we call it a wrap for the day? I'm here to address any questions or comments. If not, we'll all watch the market close and then we'll call it a wrap. Anybody? Bueller? All right, I'll pull the chat off here. All right. I did have a weird thing happen when we went live today where I kind of had to manually start the show a little bit, which is good, getting the reps in, trying to learn it. So for what it's worth, thank you all for tuning in. Saeed with Jill and I are recording an actual podcast tonight, which will be out next Tuesday. If you think of anything between now and then, just send us an email, media@higherstandardpodcast.com. If not, I sincerely appreciate you guys tuning in. And if you got this far, just know we are officially sponsored by Fridays. I'm on testosterone replacement therapy. I do microdose GLP-1, tirzepatide. I think they're super, super good for me personally. I think everybody should look into it, particularly if you have that food noise that I have. Go to joinfridays.com, use the code HIGHER. We'll get you a discount, and you get to help us help you help yourself, I think.